Treasury money mutual funds are built for cash management, not long-term growth. Here is what they hold and why people use them. This type of fund pools investor cash and usually buys very short-term Treasury securities and related government-backed instruments. Most Treasury money funds aim to keep each share near $1, while the yield moves with short-term interest rates. The goal is liquidity and stability, so managers keep maturities short and accept lower return potential than longer-term bond funds. Both can hold cash, but one is a mutual fund invested in securities and the other is a bank deposit account. A short maturity profile helps the fund stay liquid and adjust more quickly when Treasury yields change. The practical takeaway is simple. People often use these funds as a parking spot for cash, not as a growth engine. Treasury money mutual funds are built for cash access and rate sensitivity. Follow for more plain English finance explainers.